Hi, welcome back to Father and Son Investing. I am the father, if you haven't guessed. The son is currently away being a missionary for a couple of years, so I'm holding down the fort. Today we're going to talk about why March and September are the 2 months that I bond holders really need to pay attention to. None of the months in between those really matter. Each year it's March and September. Now I know you've probably been thinking, I thought it was April and October according to some other videos, and those are important months as well. But the real important months when it comes to your interest rate, March and September. So I'm going to show you why that's the case today. So the first thing you need to know is what the Consumer Price Index is. If you're not familiar with that, it's calculated in the United States by the Bureau of Labor Statistics. Each month they survey tens of thousands of goods that are purchased by households within the United States. And then from that survey they calculate how much the items cost in the past and how much they have increased, thus the inflation rate. Now the Consumer Price Index has 8 components that make it up, 8 large components. Each of these components have subcomponents as well. But you can see here that the current weighting for the Consumer Price Index is 42% for housing. So say that, for instance, last month the cost of airfare did go down. That's only within a subcategory of transportation, and that is only 18% being transportation. If we're looking at food and beverages, which most people care a lot about, that's going to be 14.3%. So that gives you the official weighting, and this weighting is done annually. By the way, the last one was done in December of 2021. Now, from that Consumer Price Index, the Bureau of Labor Statistics can generate what we call the CPI-U number. This is the way that your interest rate on your bond is calculated. If you look on the Treasury Direct website, you will see that the Bureau of Fiscal Services then uses the CPI number to calculate what the semi-annual interest rate will be for your bond. They announce those calculations in May and November of each year. You can actually calculate it for yourself in April and October of each year. But those numbers come from September and March of each year, and it's the difference between those 6-month intervals, September to March and March to September. So this is what the CPI-U number looks like. Now, you'll see here that the latest number was 296.276. What does that mean? Well, you just need to understand that the baseline was taken between the years of 1982 to 1984, and the baseline equals 100. So in order to calculate what the change in prices is, say, to August of 1983, that's just about right where the baseline was 100.2, you would simply subtract the latest number from that baseline number and then divide again by that baseline number. So the way that the interest rate was calculated for the most recent interest rate change, which started in May of 2022, was simply by subtracting the September 2021 CPI-U number from the March 2022 CPI-U number, dividing it and multiplying it, and they come up with an annualized rate of 9.62%. That's how you got that fantastic interest rate. Now, if you took the time to peruse this table, you would find that mostly the CPI number continues to go up almost continuously, but occasionally we will find some times where that number actually is higher in September or March than it is in October or April. What does that mean for your bond? It means that you're getting just a little bit higher interest than you otherwise would. For example, let's look here at 2008. The number in September of 2008 was 218.783, and then in October it went down to 216 and some change. What does that mean? It meant I bond holders got a little bit better interest rate than they would have if the government was using the October numbers. Now, what does that mean for your bond in the future? The near future being September of this year. Obviously, the Fed has been raising interest rates to get inflation down. The number for July and June was essentially the same, so for that 1 month, they did manage to totally curb the month-to-month inflation increase. We'll see if that continues for August or whether that was just a blip there, but at some point, interest rates are going to bring inflation down. Those interest rates may get really high, but what you may see for September is that you just managed to squeeze a little bit more out of your I bond than you otherwise would. So the long and short of it is the 2 months that you need to pay attention to if you are an I-bond holder and you want to know what your interest rate is going to be, or you want your interest rate to be as best as it can be. You want these numbers to be to your favor in March and September of each year, and anything that happens in between, while is certainly important from an economic standpoint and your purchasing power, doesn't really matter. Just those 2 months, March and September. If this was informative for you, please give us a thumbs up, and feel free to leave some comments about any future videos that you might like, particularly on I-bonds or inflation or interest rates. Please share this information with a young person in your life, and as always, until next time, enjoy your investing.